You've probably heard the acronym CCA being thrown around a lot, or been told that you have to claim CCA instead of the full purchase price of an item for your business. But what does that actually mean? Hi. My name is Kat and I'm a chartered professional accountant. On this channel, we discuss Canadian tax, accounting, and personal finance, with the goal of helping you keep more of your hard-earned money in your own pockets. Today's video is all about CCA or capital cost allowance. We'll go over what CCA is, how it works, and 2 detailed examples. At the end of the video, I'm going to share a free tool to help you track your business expenses, including capital assets. So let's jump right in. First of all, what is CCA? Capital cost allowance is basically the CRA's way of letting you deduct the cost of bigger business purchases, like equipment, furniture, or vehicles, over time. These are capital assets that last more than a year, which is why you can't write off the full cost in the year you buy them. Instead, you claim a portion each year, and that portion is called CCA. The CRA refers to these assets as depreciable property. Next, how does CCA actually work? First, each asset is categorized into a specific class of depreciable property based on what it is, the date it was purchased, and other criteria determined by the CRA. You can find a list of classes on the CRA's website. For example, most buildings go in Class 1, furniture goes in Class 8, and vehicles in Class 10 or 10.1. Second, each class has a specific percentage of CCA that you can claim each year. The rate for Class 1 is 4%, Class 8 is 20%, and Class 10 is 30%. Third, there is a half-year rule in the year of purchase. This basically just means that you can only claim half the usual CCA in year 1. Let's look at some examples to see how it all works. Let's say you bought a new office desk for $1,500. Since it's furniture, it goes in Class 8, which has a rate of 20%. To calculate CCA, you simply take the cost, $1,500, times the rate of 20%, and you get $300. Since there's a half-year rule in the first year, the CCA you can claim is half of $300, or $150. So, at the end of the first year, you have a desk which you bought for $1,500, minus the CCA you claimed of $150, which leaves a balance of $1,350. In year 2, the maximum CCA you can claim is $1,350, times 20%, or $270. In year 3, you take the remaining balance of $1,080, multiplied by 20% again, and the maximum CCA you can claim is now $216. So you keep doing this until the asset is depreciated down to $0. It's important to note here that the amount of CCA you can claim is anywhere between 0 and the maximum amount calculated. You're the one who gets to decide how much you want to claim. So if you already have a business loss this year, you could decide not to claim any CCA and keep the amount for a future year when you have a profit. Before we go on, if you've learned something so far, please take a second to give this video a like. It really helps the channel. Let's look at a second example. Let's say you bought a new car for your business for $35,000. Passenger vehicles go in Class 10, except if they cost more than $36,000 or are zero emission. So in this case, your car goes in Class 10, and you can claim CCA at a rate of 30%. The half-year rule applies to Class 10, so your maximum CCA in year 1 would be $5,250. In year 2, you could claim up to $8,925, and so on and so forth, until the car is depreciated down to 0. However, the thing to keep in mind with cars is that you can only claim the portion you use for business. So if you also use the car personally, to run errands or just generally drive around outside of your business hours, those expenses can't be deducted. In other words, if you use your car 60% for business and 40% for personal use, you can only claim 60% of the CCA. If we go back to our example, that would mean claiming 60% of $5,250 in year 1, or $3,150. Since the CCA amount was smaller in year 1, you have a bigger balance left over from which to calculate CCA for year 2, and so on for future years. Moreover, if you buy a car that costs more than $36,000, you have to put it in Class 10.1, which has special rules. I'll spare you all the details, but the main rule you should be aware of is that you can only claim CCA on $36,000 plus tax, no matter how much you paid for the car. In other words, regardless if you buy a car for $50,000, $80,000, or $100,000, you can only claim CCA on $36,000 plus whatever sales tax you paid, which depends on the province you live in. So just in case you were thinking of buying a luxury car for your business, because someone told you could write it off, you may want to rethink that decision. Okay, now that we understand how CCA works, I want to share a free tool I created to help you track your business expenses, including capital assets like desks and cars. It's a simple spreadsheet divided into the different types of expenses you can claim as a small business in Canada. The categories are the exact same ones you'll find when filing your tax return, so you can use this tool at the end of the year to complete your taxes quickly and easily. Simply enter how much you spent each month for each category, and the file calculates everything for you. You can grab your free copy by clicking the link in the description box below. Alright, so here are 3 important takeaways from this video. 1. CCA is the CRA's way of letting you claim the cost of capital assets over time. 2. These long-term assets are categorized into classes, and each class has a different rate at which you can claim CCA. 3. If you buy an asset that you use both for business and personally, like a car, you can only claim CCA for the business portion. That's all for today's video. I hope you found the information helpful. Don't hesitate to ask your questions or submit special requests for future videos in the comments. Be sure to hit that notification bell if you want to be the first to know when a new video is released. Thanks for tuning in, and I'll see you next time.